Flanagan with Gann Global Financial coming to you Monday morning, August 31st. And I've titled this Stocks and Commodities Remain in a Bullish Position. And the markets have progressed according to plan in one sense in terms of the trend, which we turned bullish approximately 4 months ago in both stocks. Well, actually very close to the lows in commodities, but in the stock market as the S&P pushed up through the 800 level. And so the expectation had been that in the aftermath of this historic bust cycle, that stocks and commodities would bottom approximately at the same time, because that's what occurred in 1920, in 1932, in 1948, and also in 1974 was a very interesting precedent. So we knew from history that bust cycles, there is widespread sell-off deflation in both equities and in commodities, and that is indeed what took place this time. So we have the lows having been established, the commodity lows in February, and the stock lows as of March 6th. So the markets are progressing in what had been expected, which is bull markets. Now, in looking at the S&P 500, this covers the bear market from 2007 to the March 6th low. And the overall decline was 58%, which ranked as the second greatest bear market in history after the Great Depression decline. But there was many markets that have declined approximately 50%. So essentially we're in the category of those markets. And the violence of the decline is that we had experienced on the way down was more akin to some of the legs down during the Great Depression, but we also experienced great panics during other historic precedents in history as well. So panicky conditions, banked dislocations, this is part and parcel of financial history. But what we have on this chart is in the aftermath of the low, we had made projections as to what the combined first and second leg up would look like if we replicated the great bear markets in history. So you can see that based upon the first and second legs up, the 1908 market, which was in the aftermath of the 1907 panic, the first two legs up carried price towards what would be in our market over the 1300 level, and do so in approximately December 1st. So you can see down here. And we can look at each of the other bull markets, 1938, which followed the panic of 1937, which was a post-depression. Depression is what they called it. You can see that the first and second legs up combined would carry price up to approximately the 1150 level, and do so towards the second week of October. And that is the first of the precedents to top. So you can see that our advance, and having experienced a swing high on June 5th, a corrective low on July 8th. We are in the second leg up of this bull market. So based upon these historic precedents, we would expect that the market has a very good chance of at least hitting what would be the minimum objective based upon these historic precedents. But you can see in the aftermath of the 1903 into the 1904 bull market, you can see that that was the most aggressive of the bull markets. 1974, these were the first two legs up after the 50% decline into October/December of 74. 1921, a very interesting precedent in that was the bull market that took place in the stock market in the aftermath of a very similar bust cycle to ours in both stocks and commodities. The 2003 market, we've lived through that. The first two legs up after the 2002 low in October of 2002, you can see that the angle of ascent was more muted than these five instances, and 1933, that was in a category of its own. So what we have is that we would expect that this market is going to move higher from here. What I had hoped is that this correction was going to be more severe than what we had experienced, and in light of what had taken place as the market experiences a very abbreviated correction pushing to new highs, we turned bullish. And let me read our comments from back in July. So this was a little bit over a month ago. And this would have been as of July 20th. So coming in with just coming off of this low on July 8th. I said at the completion of this projected correction, given the price patterns at 952.5 and 928.20, the odds would have favored the market moving up and through these highs with momentum. So I don't rule out this market being in a strong position. I had hoped that this correction was going to be more severe, but as the market pushed up through these highs, pushing through this high at approximately 928.20, and then basis the nearest futures 957.20, basis 952.5. I believe that was the spot contract or the cash. At any rate, the expectation is that once these highs were broken, that should provide additional momentum to the upside, and so that has been borne out by the trade. Now, this past week, we exceeded the highs. This was written on July 25th, so as we were pushing through these highs. This past week, we exceeded the highs of the first leg up in our projected bull market. This is the next confirmation a bull market is in force. On this basis, I recommend you enter long investment positions. Given the relative strength in the tech sector, NASDAQ 100, your portfolio should be weighted significantly in favor of this sector. Note, S&P 500 trading at 979. So essentially with the S&P trading at 979, that's when we issued this buy signal in the NASDAQ. And for investment purposes, we had recommended subscribers to exit all investment positions when the market broke the first leg down in the bear market. So that was at this point that you're seeing in this broken line here. So we sidestepped the entire financial crisis. The market has been quite impressive to the upside, but again, it is doing what bull markets do in the aftermath of the largest declines in history, bear markets. So repositioning our buy orders here, we essentially exited investments, re-entered investments at 22% below where we had exited. Now, and since then, we've pushed as of Friday at 1027. So, we're up about 4,800 points from where we entered, about 5%. My expectation, and what we've been telling subscribers, is that there is going to be a major correction in this market at some point in time. But based upon the history of these precedents, if we follow them, we still should be in a pretty strong position at this point in time. That would be the expectation and the probabilities. Now, looking at the cash S&P 500, a number of comments that we made. It says, having just bottomed on July 8th, we are in what would historically be the early stages of this leg up. This was really written on July 25th. Given our projection for this being a second leg up in a bull market, the odds favor the time period of the advance being at least 2 months in duration. And that's a low ball number, 2 months. So that would carry us to September 8th as a minimum to the upside. You can see that our high thus far has been August 28th. So the market has progressed, and I'm reviewing basically comments that we made to subscribers so that you can follow along what our rationale was in the going. Now, the green arrows indicate a major buy signal being given on the rally over the January 6th and June 11th highs. So when we exceeded this high in June, we experienced a pullback correction. The push to new highs issued a major buy signal for ourselves. Now, last observation here is we are approaching the violent short covering rally on October 14th, 2008. So you can see we've hit 1039.44, the October 14th high, 1044.31. So a hop and a skip to exceeding what had been that violent two-day rally. So we are regaining as we move higher. In aggressive fashion, we're regaining the dramatic losses that were experienced during the implosion in the preceding bear